Good evening, Eric Mashinsky here. I wanted to put out a quick video tonight to talk to you all about two topics, one micro, one macro. The first topic is going to lead into the second, which is the changing landscape of the investment community, the changes that are happening in terms of the socialization of finance. Right here, I've got a recent report that some of you may want to Google and give it a read this holiday weekend. It's a fascinating study by Goldman Sachs called The Future of Finance. The Socialization of Finance is the subtitle. And I also just came across another one. I would recommend Goldman first, but Boston Consulting Group also just did a piece called Adapting to Digital Advances in Capital Markets. And what these topics are addressing is that the financial landscape as we know it is changing, and it's going to change a lot. And the reason for this and the catalyst for this, and this is going to affect all of us in terms of how we invest our money today and in the future, is the two things, the socialization of finance. So there's a lot of information that we now have as individuals online that we didn't have back in the day, that we needed investment banks, investment broker dealers, and other intermediaries to be able to share that information with us. Now everybody, it's a level playing field. Information moves very, very quickly, and theoretically, the individuals actually have in some cases, advantages over the institutional community and other investment banking community as well. But the big thing that's going on is the Jobs Act, which was approved by Congress after the 2009 market meltdown here in America. This act was essentially implemented so that small businesses in America would have better and easier access to capital. And this was implemented in two phases. Number one, initially, was that you could generally solicit for the first time, I don't know if it's in history or if it's just during my lifetime, but generally solicit accredited investors or institutional investors to raise capital. And my background as a broker for 16 years, I was a financial advisor, alternative investment advisor, investment banker for 16 years, managing wealth, working with high net worth individuals and institutional investors. And one of the big problems was it was very difficult to generate new relationships via using any sort of a deal or an opportunity as an introductory conversation. There was always what was called a know your customer rule. Everybody who's in the financial community is in the financial stewardship community is familiar with this, because you couldn't just blanket advertising and marketing to anyone about a particular opportunity. You had to know that it was appropriate for that particular individual, which means you need information on their finances, their net worth, their income, their desired level of aggressiveness. What general solicitation now did, this was going back about 2 years ago, this was implemented. You're seeing the ability for whether it's a hedge fund manager or a startup business to offer out an investment in their company or in their fund. This is why you're seeing a lot of the crowdfunding sites that are popping up. One that's very, very popular is AngelList, angel.co, I believe is the URL. It's a place where a lot of the thought leaders in technology, venture capital, will end up creating a following. It's their own syndicate. They're like their own investment bank. And if they see what they think is going to be a hot company like an Uber or even LinkedIn, Twitter, Facebook prior to them going public, they can end up investing in a lot of those companies and then also offer that to other individuals that want to invest alongside them, that trust their judgment. The crowdfunding platforms are exploding, and this is creating a circumvention of the investment banks, of the investment broker dealers, and you're seeing a lot of transactions that are happening directly to the investor. there's going to be more of this in the future. And one of the companies that I'm involved in, equities.com, may be able to take extreme advantage of these trends. I was having a discussion at the conference between equities.com and NASDAQ on the NASDAQ market site back in December with an attorney who does a lot of small cap financing and legal work for public and private companies. And he made a statement to me that really confirmed my thoughts as it pertains to what's happening in the financial world. And that was, the Goldman Sachs of the future is not going to be an investment bank. It's not going to be a bank. It's going to be a website. It's going to be a media company that has an aggregation of a lot of different investors that utilize that vehicle to invest their money and to find information. Equities.com is a company that I was involved with. It was introduced to me 2.5 years ago. I'm an investor in the business. I also am now on the board of directors. And I've brought a lot of investors into the company to the tune of approximately $5 million that we've put inside the business in capital the last 2.5 years to get it where it is today. One of the things that is really blown the doors open for this company, as well as for a lot of these crowdfunding platforms, the investment banks that really get ahead of the curve are going to be able to take advantage of this as well. Some are going to be left in the dust. But just recently, I think it was the end of March, might have been early April, the second phase of the Jobs Act was approved, which is now companies can directly solicit non-accredited investors for private company, private fund investment via general solicitation. There's some criteria that is going to be needed for private companies to end up maximizing the amount of money they can raise. But I think what happened is that they really blew out of the water any expectations by people like myself, where I thought there was going to be a lot of caps on how much money could be raised and what could be done. But we're talking about $50 million as an amount that some of these companies that get audited and have some controls in place so they're not fraudulent are going to be able to market to the non-accredited investor community, which changes everything. There is the largest pocket of capital in America is this group. It's this group of people that are investors but aren't super duper wealthy people and have not had access to venture capital, private equity, and other asset classes that only the wealthy have. They're going to be ushered into familiarity with investing in private companies, just as they are with public companies. And we're starting to see these trends in place, whereas only before, a lot of these tech conglomerates like Facebook, LinkedIn, Twitter, they would have gone public 10 years ago, much earlier in their life cycle. But what ended up happening is that because of bad markets, because of costs, Sarbanes-Oxley, a lot of them financed much further along and grew their business to the point where they didn't go public until they had multi-billion-dollar businesses, in some cases profitable. And what ended up occurring is that you saw a secondary market develop for these companies. Hence companies like secondmarket.com, Shares Post, which was bought by NASDAQ. It allowed guys like me to end up investing before LinkedIn, Twitter, Facebook went public. I literally had access. I was still a financial advisor to a block of $2.1 million of LinkedIn. It was 100,000 shares at 21 bucks. And I couldn't get it approved at my firm, which just killed me because I knew it was going to be a terrific investment. But that's what's happening. And now with the start of the Jobs Act, with a lot of these things kicking in and some of the changes that have already been made in the financial market landscape, we're going to continue to see it become very normal and move down the food chain for investors to get access to private companies, invest in private companies. And really what's going to end up happening, I think, in the next 5 or 10 years is you're going to see entities like equities.com that become marketplaces in and of themselves, and they go from the public markets, obviously, but also into the privates, into the private market, where a lot of us, if we invest in, say, a private company, the only way we get paid back is if we have an IPO or the company is bought out. Typically, they're not profitable enough in tech and other industries to send out cash dividends every year. But what about those viable businesses that get very, very exciting, but they're not there yet, and they've also gone up in value considerably over the course of years? Folks are going to be looking for exits there. And so I say this in a little bit of a fragmented way to mention that equities.com is a place where you can go to see a lot of these things changing and resources that are going to be at your fingertips right now. And what we did with equities.com, which is really the goal, is to be the LinkedIn, Facebook, social network for investors. And the thought from management, the board of directors, the founder, is that whoever cracks that code has got a multi-billion-dollar opportunity on their hands. And equities is very, very far along that route to be able to put that flag in the ground, I believe, from especially where I got involved 2.5 years ago. We were able to bring in some very significant executives from NASDAQ. Last year, we hired Enzo Villani as the CEO of the company. He launched NASDAQ Global Corporate Solutions and 2 acquisitions in 2006. It's still the fastest growing business line in NASDAQ and accounts for close to $500 million in revenue for the exchange group. Enzo's an acquisition guy, and very exciting in terms of growth, because we've already bought, since he came on board, VantageWire, which many of the Canadian investors that are listening to this may be familiar with. He was able to recruit 2 significant folks to the group as well. Mike McDonald, who spent 15 years at NASDAQ and was the CTO of the Global Corporate Solutions. He had a team of over 170 staff when he left in 2014. He was also the co-founder of Weather Underground. This was sold to Weather.com in 2013. He's an experienced chief technologist and entrepreneur. The sale, even though he's modest about it, was a significant win to Weather.com. But really the pedigree we're talking about here is we're attracting folks from NASDAQ, which know that in the direction things are going, this is the future. Last but not least, we were able to attract, Alfred Berkeley, to our board of directors. He's the former president and vice chairman of NASDAQ, former chairman of the World Economic Forum U.S. delegation in Davos. Significant folks. Right now, what we've got going on, equities.com has filed their S1, which is a registration to become a public company, to go through the IPO process. We initiated this process over a year ago, have gone through the bulk of all the questions and answers with the SEC. It's really a matter of timing in terms of when we feel the timing is best to go public. And I think that we're looking at a Q4, Q1 timeframe for that. But the opportunity is that right now, in the interim, we are raising $2 million at 50 cents a share to finance growth, to finance technology development, including a robust mobile site, sales and marketing, and we've also got some significant acquisitions that are being vetted out as well. But for my listeners, my subscribers, my members that have known me and would be interested in private deal flow, private placements, this may be one to consider. The minimum, because we've got a crowdfunding component to this, is very low. It's only $10,000 to get involved, and obviously, if you have an appetite at $100,000 or $250,000, that's fine as well. We are planning, this is always when things have to be dictated by the street and validated by the street. We're targeting an IPO that would bring us much closer to the $100 million valuation than it is today at $33 million pre-money. Even if we get this into the $70 million level, we're looking at a $1 IPO from the 50-cent mark. And, this is probably within a 12-month period from today. So certainly not a bad late-stage venture capital type of an opportunity if that ends up becoming true. Lastly, I'll just say that, investment bankers and broker dealers, we're not going to have a problem getting that sponsorship, because if you think about it, equities.com has got the user base that could really self-underwrite, if not all of it, a big part of the IPO. If we're talking about a small initial public offering of 10 or 15, maybe $20 million, we have a user base that is very dynamic and growing. Back in March, where I have the data, we had just under 500,000 unique visitors to the site. The growth in this is absolutely exceptional in terms of 5.4 million page views in March, 75,000 plus subscribers. The traffic growth has been up over 1,500% since January 2014. So this is a site and a business that is growing fast. It's aggressively growing on all metrics, and I think with the team that's in place and the wind at our back from a social and regulatory standpoint, this is an interesting play. So if you would like more information, please, you can email myself for a PowerPoint presentation, subscription documents. I'm happy to send those over. You can email me at eric@equities.com or eric@phenomventuresllc.com, and I will be able to send you that information. And then if you are interested, we may have one conference call with the CEO and founder to address any questions before this round closes. We've got approximately $1 million in commitments currently out of the 2 million. So this will be finalized sometime probably by the end of June, maybe June 15th. We may have a Q&A conference call, or if you have an appetite in the $50,000, $100,000, $250,000 range, certainly a call with the CEO directly can be arranged as well. And thanks for your time on this. I appreciate it.